Welcome back to this tutorial on financial modeling using Kaluta projection methodology. Last time we ended up establishing the capital requirements, that is the total capital needed to be injected into this projected business. In this tutorial we are going to learn about how to model the loan. Before we proceed in loan modeling, let us recap and emphasize points on establishment of the capital needed to be injected into the business. So that you understand this approach versus the approach that is normally used when you do an indirect cash flow method to determine the working capital requirements. Okay, so to do that, let us go to our cash flow here and let us first remove this capital injected figure of 25 million we did. So I tap to clear this. Now, as we said, the negative cash at the end of the period, that is the overdraft amount in this case, because cash inflows are less than cash outflows, it is peaking in April when the cash flow at the end of the period is here, 19.552 million. Okay, so that is the peak where the cash flow is negative. After that, from May, it starts to reduce until the negative cash is extinguished in July. So August we started to generate positive cash at the end of the period. Now, we said when we were establishing the capital, we said 19.552 million. This is the maximum amount of money we need to inject into this business so that it can sustain itself. And we said let us put 20 million. We put 20 million and then we added 5 million as a buffer capital. Okay, now let me explain further about this 19.5 million. How is it broken down in terms of capital requirements? Okay, so we have, let me double tap to, so we have the working capital WC component of the capital, which is, in our case here, let me put equal sign so that to start a formula of summation. We are going to sum the total cash flow from operations, which is in negative. That means the cash inflows, in this case sales, are less than the cash outflows, which are expenses, and we ended up having a negative total cash flow from operations. So I'm going to, we see the total cash flow from operations is negative up to April. From May we start to have a positive cash flow from operation. So I'm going to take the figures, I'm going to sum all the figures that are negative total cash flow from operations to establish the total shortfall that needs to be covered by the injected capital. So that means I put a sum there to sum it from here, and then I highlight this up to here when it is negative. And I just need my, because these are negative, I need to have a final answer as a positive. So I start my formula with negative number, I mean negative sign, and then press enter. So we see cash flow from operations is what which is presented as working capital of the company. Okay, so normally when you use the indirect method of cash flow, you will start with profit before tax, and then you will adjust for non-cash items like gains and or losses, depreciations, and then after adjusting for non-cash flows, you will compare the current assets and current liabilities. When there is increase in assets, that draws out cash, and when there is increase in liability, that increases cash. Okay, so you'll make those adjustments to establish cash flow from operations using indirect method. But in this method, the total cash flow from operations is established directly from real transactions or expected transactions that have been modeled. So we are not doing it by doing adjustment or engineering our accounts to derive the cash flow from operations. Here you see transparently how much cash sales you expect, how much debtors collections, cash purchases, creditors payments, salaries and wages, rent, etc. So everything you see it transparently. This is the beauty of this approach of financial modeling of the cash flow, because it gives you a real situation of how the cash flow is expected, instead of reverse engineering the figures to determine the cash flow from operations. And as I said, if you are modeling for overdraft, this is the only way banks will accept your cash flow projection. They will not accept indirect method. Okay, so it's important to learn this approach, even if you are used to using indirect method, or even the direct method that is used using accounting principles. You still need to do some reverse engineering of the transactions, because instead of profit before tax, you will have direct sales and direct expenses, and from there you will have to reverse engineer the current asset and current liability transactions to determine the cash flow from them, in order to arrive at the cash flow from operations. So it is still limited to showing you transparently the way the cash flow is expected, compared to this methodology. And well, maybe nowadays, but in our times, this was not the approach that was used to train accountants. So if you are in a situation like I was, and if this is still the practice today, then attending this tutorial of mine is very important, because as I said, I developed this methodology in order to fill the gap between the contemporary shortfalls in cash flow projection that I have experienced, or that I have witnessed while doing my jobs as a banker and as a consultant, okay, freelance consultant. So we have established the working capital requirements there, and let us now take the capex component, the fixed assets capital expenditure component. So fixed assets, cash requirements, okay. Again, I put the summation formula here, and I go to pick from cash flow from investing activities. Here we have two items here for furniture and fittings and computers. We are just interested in purchase of fixed assets before we break even and start generating positive cash flow. So in this case is for furniture and fittings and computers during the month of January and March only, okay, and not because this is the time when during year zero, when these assets were purchased and before we started to generate revenue. So I sum total cash flow from investing activities. I click here and then drag this to, let me repeat again, fixed assets. Say sum from here up to here, and then enter. Okay, so I need this to be positive figure, so I come back to this formula here and start my formula with a negative sign so that the figure turns out to be positive. So you can see the sum, let me sum these two components, and we get total, which is 19,552,800, which is exactly the amount of negative cash flow we had when the negative cash flow peaked at April, before it started to go down. Okay, so the total capital requirement for working capital and fixed asset here is the one that we need to inject as a capital to run this business. Okay, so if this figure was injected completely as it is, So the capital section, which is here, so if we put 19,552 800 as the injection of our capital, what we see in April, cash flow at the end of the period would be 0. Okay, and from May we will start to have positive cash flow, so we don't have negative cash flow. Okay, but as I said, we need a buffer capital, just in case our projected outflows becomes bigger than expected compared to inflows. So instead of having this 19.552,800 exactly injected as capital, we said let us put 25 million as the capital injection needed. So that is what we went through, and that is what I wanted you to understand, how this capital injection exercise done using this Kaluta projection methodology is different from the indirect method or even the direct cash method you use, that you are trained as an accountant to establish the working capital component. Of course, fixed asset component is the same whether you use indirect method or direct method of accounting or this method, because cash flow from investing activities and cash flow from financing activities are reported in separate areas after establishing total cash flow from operations. Okay. Later on, when we are done with the tutorials for loan modeling, we will do a comparison between this cash flow and indirect cash flow. That means we will derive indirect cash flow from these financials and see how total cash flow from operation matches whatever method you use. But definitely this is the best. The way I'm using here is the best one. Okay, so let us go back to the subject of this tutorial. We are going to do modeling for a loan. Now, to do that, I will need to create a sheet. So let me put that sheet before assets. So I click on assets here and then click a plus sign to create a sheet, and then click on sheet name to rename it as a loan. Okay, and then let me go to the assets here, copy, select, first highlight okay, I'm trying to highlight. Let me start from the beginning here. Oh, I can't highlight. Okay, so I am highlighting these two rows so that I can copy them and paste them. I copy and paste them in the loan area here, fill and then paste, so that we have the same structure. Now let us model the loan requirement. So I just leave one row here where I will put interest rate and number of installments, and start from where I am located. Let me double tap to open the type menu and then type opening balance of the loan, and then we will have after opening balance we will have installments. So we need installments, particular for installment. Then we have particular for interest rate, interest amount. Then we have particular for principal component of the loan, and then we have closing balance, and then we have a component for short-term components of the loan. Just say short-term component of the loan, and then we have long-term components. So let us model this. Now in the cash flow here, instead of having a figure of 25 million as capital injected in this business, let us assume that the sponsor of this business can inject only 10 million. That is the money he has, and the remaining amount, that is 15 million, he has to seek bank loan to finance the business. So instead of 25 million, I'm typing 10 million. So our capital is 10 million, and here I add loan component, and this one is 15 million. So I type 15 million. So this is how our business is funded now. Okay, now we come to the loan sheet here, and let me double tap on a header to expand this. So installment, here at the section of installment, I put a formula, start with equal sign, and then click on the loan, click on the cash flow, and pick the 15 million here as our installment, and then press enter. So we have the installment. Let me first arrange these this area into accounting formats. So I go to 1, 2, 3 here, click on this separator and then go back and then remove decimal places. Okay, and let me freeze pane here so that we can see the rows for year and month and the column for particulars whenever we move around, whenever we scroll on this sheet. So go to view and then freeze pane. After doing that, let us now go on modeling our loan. So we have put installment. Let's say the interest rate negotiated by the bank is 20% for this loan. Okay, so I double tap here to type 20%, that is per annum. Okay, 20% int. Why is becoming 0? Okay, maybe let me just okay, here we are in the opening balance. First of all, I was not supposed to put it in the opening balance, so let me remove this figure. It should be on top of here, on top. So let me put 20% and then enter. Let me format this number. So I go to home and then format. Where do I find my format? I'm not very used to using the Android. I'm used to laptop, so sometimes establishing where to go in this becomes a challenge, but it should be, let me try here. Yeah, so that is percentage, let's try. Yeah, that one. Okay, so I can remove decimal places here. So it's 20%. And number of years, let us assume that this is the loan for 3 years. Okay, so I double tap. First I start with equal sign and type 3, those are 3 years, but because we are modeling on monthly basis, so I have to multiply by 12 to get equivalent number of months that are going to be covered in this exercise. So it's 36 months because our loan modeling is on monthly basis, and this is exactly what you should expect from the bank. So I'm done with that. Now let's model the interest component. Before that, modeling interest component, let us model the closing balance. The closing balance here will be equal to opening balance. So I click on the opening balance plus okay, there is something I have left there, so let me exit. I have, between opening balance and the installment, I need to have addition. So I'm inserting the row there, insert row, and put double tap to write addition of the loan. Addition. So my closing balance will be equal to opening balance plus addition of the loan minus principal component of the loan, not installment, not interest, the principal component, because we are dealing with the loan here. Okay, so minus B8 and then press enter. So this is my formula for closing balance, and this formula is true throughout, so I tap to fill this and drag this to the end of our projection period. Okay, now let us model the installments. Okay, we've said there will be 36 installments here, and because, let us go back to the cash flow here. So if we delete these two components here, if I delete capital and loan clear, we see that we will have negative cash flow at the end of the period until July. So August is the month where we start to have positive cash flow. So if you are taking a loan, you should seek for grace period up to August, because from August, according to your business modeling, is when you expect to start to have net cash flow that is enough to settle loan obligations. Okay, so the repayment of the loan will start on August. Okay, so let us go back to our loan modeling. So we go to loan installments will start be paid on August 22 here, and there will be 36 installments, okay, in total. So let's see where the installments will end, and before that, let us put the formula for installment here. Okay, so the formula for installment payment is, you start with equal sign and then put minus and then bracket and then write, let's go to this writing pad, PMT, okay, PMT, and then close the bracket, open the bracket, PMT, you pick the interest component, that is 20%. It is here, so I click on here, and because we are modeling on a monthly basis, So I divide this by 12. Then I put comma. I pick on number of installments, which is here, C3, and then I put comma again, and then I pick on addition for the loan, which is here, loan amount given, which should be here. Okay, so that is how my should here. I think let me see if I have the formula right. If we finish this, definitely I think we need to remove this no, that one will not be okay. Okay, let me try to put this and put another bracket at the end. Because we have two brackets here, we need to have other two brackets. Let's see if this one will work. Okay, so let me put the figure for loan. So I'm going to pick this from, so I put I double tap, put equal sign, and then go to cash flow, and then pick the loan, which is here, and then press enter. Okay, let's go back to the cash flow. You remember we deleted capital and loan while we are demonstrating on where should we start to repay our loan. So I'm going to retype the figures. For the capital was 10 million, and for the loan was for 15 million. Okay, so that is where we were. And now if I go to my loan sheet here, I have addition of the loan, which is 15 million, and I have installment. This is the first installment, so the formula is okay. This is the Excel formula that is used for computations of loan installment payments. Okay, so we will have, because we have used in this formula installments to be 36, because we picked loan installments number to be 36 from the formula here. If we go back again, 36. Okay, so this one needs to be accounted 36 times, so I will have to drag this 36 times. So if we start in August, this is the first. Let me put equal sign here, double tap to put equal sign, and then pick, because the installment is going to be the same each month for the loan. So that is the second installment. Let's count 36. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36. So the 36 installments will end on July 25. Okay, So I drag this one. I drag this one because I put a formula here to just pick the figure in August. So I tap to fill up to July 25. There is where my installments will end. Here, July 25. Those will be 36 installments. Okay, and after that we come to model interest. Before that, we have the closing balance here, which will be the opening balance. So I put equal sign. The opening balance for February will be closing balance for January. So I pick this figure here and press enter, and then this formula is going to be true throughout. So I fill this to the end of our projection period. Okay, then let me first rearrange, select all the columns in a row, and then go to this format cells, auto fit column width, so that we see all the figures. Okay, then interest. So interest component is charged from the opening balance. So we will start to model it from February here, because in January the opening balance is 0. We've just started with the addition of the loan. So we are going to model interest from the February, and the interest is going to be I put the formula here now, double tap to start with, equal to, is going to be the interest rate, and because we are modeling on monthly basis, it will be interest rate divided by 12, because this is 20% is per annum. But I want my formula to be picking on B3, where the interest is, whenever the formula is dragged. Okay, so I need to lock cell B3. So to do that, I'll start with the dollar sign. Before I type my B. Let me go to this typing pad, B, and then put again a dollar sign. And then B3. Okay, so there is where the interest is, and because I've used dollar sign to lock both column and row, so whenever I drag this formula, it will pick on the interest. It will pick on B3. So this interest rate divide by, let me go to this pad, divide by 12, we get the equivalent of monthly charges for interest, and then multiply by opening balance of the loan. In this case is here for February. So I press enter. So that is the interest component, and this formula is going to be true throughout. So I tap to fill this. Throughout our projection period, or throughout our loan period. Let's drag it to projection period in this case. When there is no need to have it, we will see. Okay, so we are done with the interest, and for for example, if you want to see the logic of the formula, if I click here and click on the formula bar, you'll see that it has taken B3, which is locked, divide by 12 to get a monthly equivalent, multiply by E4. Okay, so the E is relative, the E column and is relative, but the B1 is locked. That's why we have managed to compute interest here. Okay, yeah, there is the lesson about absolute and relative Excel formulas in previous tutorials, so you can go and see it if you want to learn more about this. So I'm done with the interest component. Now the principal component of the loan is simply will start to be calculated here when we start to pay installment for the loan in August. So the principal component, I put a equal sign here, will be equal to total installment minus interest. That will give you the principal component of the installment you pay for the loan. And this formula is going to be true throughout, so I fill this till the end. Okay, let's go on. After that, then we need to establish short-term component of the loan. Short-term component of the loan is about the installment, principal installment that are paid within 12 months. Okay, so if I am here in January, I will need to sum principal installments paid from February up to January, where 12 months are complete. Okay, so I will put a summation here and then click on C8, which is the principal component in February, and then drag this up to January. Oh, sorry, let me repeat again. So I need a formula here. First of all, let me remove that and then click on equal, click on here, not here, principal component, and then drag. Oh, why this one is not accepting? Oh, that is the problem of using Android for Excel, because I'm not used to it, so sometimes I'm getting the challenges, because I need to select my summation should start from February up to January, so I need to drag this cycle here, but when I try to do that, it takes me somewhere else. Okay, now I have managed up to January. Those are 12 months. Okay, so I press enter. So that is my short-term component, and this formula is going to be true throughout. So I simply tap and fill this throughout the projection period. I will show you why is it true throughout. So for January, when I click on the formula bar, it has picked from February up to January, when we have 12 months. If you go for February here and pick on the formula bar to select the formula, you'll see it has picked from March up to February, and so on. Okay, and so on. So if you pick, say, from June here, click on the formula bar, you'll see it has taken from July to June, which is 12 months. So that is the short-term component of the loan. Remember, the loan is reported on the principal amount that you are supposed to pay from the installment. Okay, so that is the loan. That's why if you take all the principal installments here, which we have derived after taking installment minus interest rate from here, and then select till the end of all these, let me select all these installments until the end. Okay, so summation, you see, sum to the bottom right corner of this Excel sheet, there is after cash flow sheet, there is sum. It is 15 million. Okay, so the highlighted cells have been summed up, and we get 15 million, which is exactly the amount of loan we are modeling. Okay, because the loan is derived from the principal component of the loan. Okay, that's what you pay. You pay what you have actually taken a loan for. Those interest payments, those are the charges for the loan. It's a different thing. Okay, right. So we have already accounted for short-term component, and long-term component is simply now the closing. I put the formula here: the closing balance of the loan minus the short-term component. Okay, this is the component of the loan beyond 12 months period. The short-term components in balance sheet, it falls under current liabilities, while the long-term component, it falls under long-term liabilities. Okay, so this formula is right also. I drag it to the end of our projection period. Our projection period. So after doing that, now we are ready to input our numbers into our financials. Okay, our loan transactions into our financials. After finishing inputting all the transactions, then our balance sheet should balance. So we start from profit and loss. Here we need to add interest on loan, that is finance cost here. So I double tap to write loan interest. And in January there, put equal sign, go to the loan sheet and pick the interest component, that is here, January, here, enter, and then this formula is going to be true throughout, so I fail to drag it. So we have already added the interest, but we need to put a formula here to sum total finance costs. So I put the formula summation there, and then tap to fill this throughout our projecting horizon. So we are done with the component in profit and loss of the loan, that is loan expenses, has already been added, and of course net profit before tax, if I click on the formula bar here, has already taken into consideration the finance cost by deducting them, which is B30, to arrive at the net profit before tax. So we have already we are done with the profit and loss component. Now let us go to cash flow component. Here we have debited cash, we have debited loan interest charges in profit and loss, and we need to credit them in cash. So here I will add in the cash flow from operations, I will add a line item for loan interest. Loan interest. And from January here, I'll just go put an equal sign, go pick it from P&L here. Okay, but because we need to draw out for loan interest draws out cash, so I start with negative first and then click on loan interest here and then enter. So we have that formula already, and tap to fill this throughout the projected period. So it is covered there already. Let me remove this one, clear this. It is covered already in the interest, in the expense part of the cash flow. Now we come to the financing part of the cash flow, which is cash flow from financing activities. We have capital. We are done with this. Oh, we put capital in June here. No, we were supposed to put it in January, so I'm deleting these two figures here. I'm deleting, clear this from here. They were supposed to be here. So loan January, so capital should be 10 million. 1, 2, 3, 4, 5, 6. And loan is 15 million. 1, 2, 3, 4, 5, 6. I typed at the wrong place when I had to retype them again after removing them. So now I've typed at the right place, and in the loan computations here, addition here, you see, because I picked it in the wrong place, so I'm going to put a formula here so that I pick addition at the right place in the cash flow, which is now here in January. Enter. The rest is okay because the rest have formula, so it's okay. So in the cash flow here, we are done with the interest component that draws out cash from the cash flow. We have the loan repayment, so I need to insert a row here, insert row, and add a line item here called loan repayment. Loan repayment. Okay, as I said, this is the financing of, this is the loan itself apart from the interest. Okay, and this is this falls under cash flow from financing activities. That's why it is here. So I'm putting equal sign here, and because loan repayments draws out cash, so I start with negative and then click on the loan sheet and click on the principal here. These are the loan repayment principles. So I click here and then press enter, and then I drag this throughout because it is true. To the end here. Up to there. So the loan repayments have already been considered. Let me see if they are included in the formula here. No, not included. So let me repeat this formula again. Sum, so that it sums all, and then I drag this, I fill this formula throughout our projected periods. Okay, sorry, 1 minute, I'm coming back. Okay, so let's proceed. So we have already captured loan repayments in the cash flow, and now we are left with the transactions to be reflected in the balance sheet. We are done with the profit and loss statement by expensing loan interest in the cash flow by drawing out cash from the interest payment and from the loan repayment. Now we are going to balance sheet. So let me slide to the left to get the balance sheet here. And as I said, there are two components of the loan. The first one is in the current liabilities here, so I put it on top of creditor. So I click on the credit and then insert rows, and then put double tap to type ST short-term loan. Short-term loans. And here I put equal sign, click on the loan sheet and pick them from January here. That is the short-term component of the loan. Press enter and then drag this, first tap to fill and then drag this to the end of the projection period. Okay, so I am done. Let me clear this last one. I'm done with the short-term loans, but let me make sure that the formula below here, total current liabilities, picks it. Right now it's not picking it, so I'm clicking here again to use the summation formula to sum it again so that it covers the short-term loans also. Check this up and then fill this formula throughout the planning horizon. So we have covered the short-term component of the loan, and we are left with the long-term component of the loan. Up to now, you can see in the check we still have a negative. The balance sheet does not balance because we have not introduced the long-term portion of the loan. So I double tap here to type long-term LT loan. Long-term loans, and put equal sign, go to the loan sheet and pick here in January B11, that is the component. Press enter, then tap to fill this formula throughout because it is true throughout the projection period. So we are done with that, and our balance sheet now, as you can see, it has balanced. So that is how we model loan, and to recap, let us go to the loan sheet so that to explain a bit more, not to recap but to explain a bit more of what has happened in our numbers, loan numbers here. So for installments, as we said, there are 36 installments that ended in July, and we said the first installment starts in August. Here is where we expect to get enough cash from our cash flow to service the loan. Okay, so this is the beauty of planning for your business before you do it, because it helps you to realize the challenge that you may come up with and address them in advance of time by planning them ahead. And the interest, we dragged it till the end, interest formula, but definitely when the opening balance is 0, let's see, interest component here, it goes up to so the interest ends in August here. Okay, this is the third year. Because the opening balance is 0, so the formula that is used for interest here, it picks opening balance which is 0. Okay, so that's why we have no interest from August 25, because our loan is extinguished by July 25, because it is 36 months. Remember that here is where our 36 installments ended, and definitely here is where our loan payments in July ends. Okay, principal the same is paid up to here. When we come to closing balance, again the closing balance for the loan ends up here in June. It ends in June. And short-term component of the loan also ends in June, because for the month of June, the summation of 12 months is only one item here for July, so the short-term component is only this one. For the long-term component, we see the long-term component, we've stopped accounting for it in June here. Why? Because starting from here in July, if we click on the formula of long-term component, it takes closing balance minus short-term component. Here in August, closing balance and short-term component are the same, so we get nothing out of long-term component. And as you know, the long-term component covers the period more than 12 months of a loan repayment, I mean of the principal installments of the loan. Now we do not have more than 12 months. From July, we do not have more than 12 months of paying principal repayments, because the principal repayments ends in June here, sorry, in July here. So we do not have more than 12 months. That's why the long-term component here is 0 all this time, all these places from July. Okay, so that's what I wanted to explain on this loan scheduling. Of course, there is loan amortization schedule in Excel. You can get it, just feed the loan amount, feed interest rate, feed number of installments, and then it will compute automatically the installments. But the beauty of knowing how to do it yourself is because now you can arrange these transactions in line with your projection methodology or projection approach you are using, and it becomes easier to fill them into your financials because they have the same format of what you have modeled them, instead of using the deriving the loan amortization schedule from Excel. Okay, you just model your loan amortization schedule yourself like this one. So guys, this is the end of this presentation on loan modeling, and of course on explaining the capital requirements and how to interpret them using this Kaluta projection methodology. Let us end up here for this lesson. Please subscribe to my channel so that you get posted of the new tutorials when they hit, and of course you help me getting subscribers and video watch hours that one day will enable me to start getting paid by YouTube, if you do that, of course. And if I get paid, then I'll get the energy, I'll get the resources for me to keep on bringing you this stuff about financial modeling, because they need time, they need money to make them, and definitely I cannot keep on using my own resources. So you need to support me by subscribing and like videos if you can, so that give comment if you have any question about my approach, you want to know more, you can do that. And as I said, once I am done with all the necessary tutorials, then I will look on the possibility now of you could start to give me, you have the real project and you want to prepare financial modeling for it. So you can DM me and tell me, and then I will do it free for you, but under condition that you allow that business model. Of course, we will change numbers so that they are not exactly the numbers you are using, so that that model can be shared and members can use it to model their businesses, because I need to have real life projections in various industries, so that we have a flexible way of doing the modeling based on your industry area and specific requirements of your business. Of course, I will only start that if this channel is monetized. So your subscription, your likes is important before I can be able to start that project of modeling real world financials for your business for free. So thanks guys for being with me up to now. Bye for now. See you in the next tutorial.